There'll be cycles, there'll be ups and downs. This is a business of not selling. This is a business of retention. So wealth and investments is a business of not of selling. You don't make any money when you sell a product. You make money only when the customer stays with you for 5 years. Take a long view of life. If you're in financial services, it takes time. Financial services are organic businesses. Unlike, let's say, a food business or a transportation business or e-commerce, you can't manufacture scale by throwing money at the problem.
Hello and welcome to the Startup Operator Podcast. I'm Roshan Karyappa. If this is your first time here, welcome aboard. We curate insights from India's best founders, operators, and investors. Learn what it takes to build and scale a startup. We have another amazing founder on the podcast today. Subu is the co-founder of Fisdom, and Fisdom is an investing platform that aims to make financial products accessible, understandable, and easy to purchase. Subu was earlier managing director at Bessemer Venture Partners and has seen both sides of the table as an investor and a founder. In this conversation, I speak to him about how Indian startups have evolved over the last decade or so and how VC funding specifically has impacted this. Then we discuss some of the nuances of building a wealth tech platform like Fisdom. What is it like balancing growth and also being responsible and protecting consumer interests? What does it take to comply with regulation? And what are some of those unique insights Subu has learned from being an operator in the space? Before we dive in, if you like our content, don't forget to rate and review us on all of your favorite platforms. It helps more people discover us. And also a shout out to our sponsors. This episode is sponsored by Park Avenue. More about them later in the podcast. For now, we'll dive into this episode of the Startup Operator Podcast with Subu of Fisdom. Hey Subu, welcome to the Startup Operator Podcast. Thank you so much for making the time.
Hey, thanks, Roshan. Thanks for having me. It's a pleasure. Thank you.
Awesome. I've been looking forward to this because our mutual friend and acquaintance Ravi had suggested your name to me, and very excited to have this conversation as well. Subbu, you've been involved in the Indian startup ecosystem for quite a while now, right? And there's been a sea of changes that have happened over the last 10, 15 years. Having seen the ecosystem, how it was maybe 15 years ago to how it is now and how it was in 2021, etc., right? With the bull run of bull runs in some sense. What are a few things that stand out to you?
Well, look, it's dramatically changed. Okay, I mean, first time I started working in the startup ecosystem was 2010-11 when I moved to Bangalore to start Bangalore offices for the VC firm that I used to work for, and just so much has changed. I mean, this itself can be a long podcast, but I think a few highlights for me are just one, as everyone would say, look, just depth of the market. When I say depth of the market, this has multiple parts to it. One is the depth of customer base, the market size, a majority of founders, number of VC investors, majority of VC investors. Sometimes we forget that the VCs of the first generation were also learning the game as we founders are learning, right? And then amount of capital being available. It is such a sea change. India probably adds amount of capital in a fortnight as much it used to add in a year. At 12 years, which you don't realize. Every week there are like hundreds of millions of dollars, and a few $100 million would be the full year deal value in 2010-11. So I think huge sea changes. For me, what stands out is massive risk taking ability among founders. Lots of first generation founders coming out of various education institutions. That's one piece. Second is significant amount of capital to fund this risk appetite from across the world. And third is depth in the consumer behavior and markets in terms of there's a critical mass of 200, 300, 400 million people, depending upon what cut you take, because middle class in India is a debatable topic, right? What is middle class? Is it 100 million? Is it 50 million? Is it like, if you talk to someone like Kunal Shah, he'll say 50 million. And if you talk to somebody like Phone Pay, they'll say 300 million, because those are the people who are using the app. So whichever way you look at it, I think those would be the three big changes the way I see from 10, 12 years ago when the ecosystem was very, very small. I remember when I moved here, I knew every investor, every company in Bangalore, literally every founder and every. Now it's just so much deeper. So generally, I would say it's much deeper, much sharper how the ecosystem has changed over the last 10, 12 years. For sure.
Yeah. No, I've been doing this for about 2.5 years. And, I have this constant fear at the back of my head that, maybe I'll run out of people to talk to, right? And every week, every couple of weeks, I discover someone or, some startup who's doing some amazing work that I had never known hitherto, right? And that is when I kind of realized that I'm just probably scratching the surface. Yeah, some of the unique things that come to my mind is that, I think this internet usage, right? I mean, is also monetizable thanks to UPI and all of the framework within that, right? And that makes a key difference, I think, right? Because now you have a situation where the monetization also parallels the sort of internet growth, right? I mean, it's 600 million internet users, right? So
Yeah, yeah, absolutely. You probably add one other thing. Sorry, if I think the other big change, Roshan, from 12 years ago to now is the fact that failure to a large extent is acceptable. This was just not the case 12 years ago. Like people would dread, shutting down their startup and doing something else. And like, for example, we at Fisdom have so many ex-founders as employees, and ex-founders are founders do a brilliant job as executives in many other companies, right? Just it's okay to startup and fail itself is a big change in the next last 10, 12 years. I forgot to mention that.
yeah, no, that's a very important point, right? I mean, I think there was this whole anathema around failed founders, right? I mean, I still remember I was a founder, and when I folded up my startup and I had to move on, I mean, things were really tough. I mean, I'm talking about 5, 6 years back, right? Since then itself, I mean, it's come a long, long way. I mean, today people look for failed founders because they understand that these folks have been on the outside, they know what business works at a macro level and can close the loop and so on. When we talk about venture capital, right? I mean, you mentioned 2021, perhaps, what happened in a couple of weeks would have been the whole year's activity maybe 10 or 12 years back. And overall, I feel it has been a net positive. But then, I was reading Mr. Anand Lunia's post last week, right, where he argued that for some folks, I mean, the journey has become the destination in itself, in the sense that, I think he was referencing a lot of the secondaries that happened, a lot of the crazy valuations and multiples. And overall, there's a sort of an excess in the startup ecosystem, right? And, startup building per se has gotten slightly corrupted in that sense, right? I mean, so when you look at all of these things, how do you see the impact of venture capital on startup growth and startup building in India?
Yeah, look, great question. Obviously, I my first part of my career was as an investor. Spent most of my career as an investor. Even 9 years I was a venture capital investor. Obviously, there's a mixed bag here, Roshan. There are some really large number of positives that the venture ecosystem has brought in venture capital world. I mean, obviously, because of the capital that's available, in large amount, I would credit to the enhanced risk appetite that is there among Indian founders to availability of capital. Okay, a lot of people like us would not be founding and starting companies but for availability of capital, right? So I think there is something to be sort of recognized there. Hey, listen, look, this capital helps people a certain amount of motivation and to go and fund their ambition in building a product, building a service, etc. But obviously, there have been excesses, as you said, and as Anand also wrote in his op-ed. I think the some of the ramifications of some of the excessive funding is the following. Sometimes I joke that if any of your colleagues and if your friends have seen their salaries go up 10x in the last 5 years, you need to thank your thank the VC firms. A
Thank
lot
you,
of the
friendly
money that
VC.
companies have raised has gone in, creating massive inflation of some skill sets, particularly around engineering, product management, and so on and so forth. Where I've seen, 30-40% annual pay hike is considered as like, hey, what are you even talking, right? So I think some skills have just got massively overinflated. The other downside or side effect of excessive funding was, I keep saying, Google and Facebook have to thank the VC world for their increasing revenues in India. So is IPL. So much of capital that was raised went into either funding employees at exorbitant prices or funding marketing at without an ROI. And I have a bit pragmatic view on this in the sense that these are cycles. We just have to live through these cycles. There is excessive cycle and there's a down cycle, and both public markets and private markets keep going through this cycle. I think the mature founders and mature VCs recognize that these are cycles and take a step back and say, hey, listen, look, I recognize that this is a difficult period or this is a easy period, and I don't want to get carried away. And mistake was a lot of founders as well as investors got carried away last year. The other change, that happened last year, last 2-3 years also, Roshan, has been, we also had a lot of first time investors also. It's not just last time, a lot of first time founders. Many partners who are writing crazy checks were also investing in their first cycle, first fund cycle. They've only seen post 2008 bull run versus, hey, listen, look, there was a world before 2008, before 2015, and so on and so forth, right? So I think so. That whole everyone trying to learn the game on the way, on the job, both investors and as board members, as founders, as executives, everyone's doing their first time job, and there's just too much money. They just don't know what to do. And I think, as I said, I have a pragmatic view on this. These are just cycles that come and go. One has to have the maturity to say, hey, listen, look, this was at least I keep telling myself that, look, nothing is as good or as bad as it looks in the first place. So last year I told myself, look, this is not reality. And this year I'm saying this is again not reality. Like the kind of gloom I'm hearing everywhere, hey, listen, look, salary cuts and this and that, it's not as bad. Like I think that India continues to be, we need to kind of cut through this noise of excessive pessimism and irrational exuberance and say, hey, listen, look, where is the middle ground? To summarize to summarize to your question, I think venture world has enhanced the risk appetite of founders and has definitely deepened the market. If that money hadn't been funded to create so many internet users, many companies would not have got created. At the same time, I think last year it was just like completely bizarre. My final comment would be there needs to be some balance between the relationship between investors as board members and founders. In India, the moment a company crosses like $1 billion of valuation, the founders are unstoppable. They're like the alpha males who can do no wrong, no matter what the revenues are, what the profitability is. And investors just lose the right to say anything. They don't even say anything to the founders. I think somewhere that balance needs to be restored where, at the end of the day, founders are still responsible to the board and investors. Just because the valuation is increased to $1 billion doesn't mean they can do whatever they want, right? So I think some of that resetting has to happen, and I'm hoping that there will be all those resetting happening. And I completely agree with what Anand wrote in this op-ed.
Yeah. No, I think that's another key change, right? I think the power balance has completely swung the other way in some sense. And I think there needs to be a healthy median there. It's so weird. I mean, I met this founder who is probably doing about $3 million ARR, right? And they simply have to, after being bootstrapped for about 10 years, they've had to raise funds right now or in the market for funds only because they can't afford the kind of salaries that have happened post 2021, right? So I think, yeah, in some sense, it's a long due correction. We tend to be way too optimistic during optimistic times and we way too pessimistic during pessimistic times, as you mentioned. But yeah, I mean, it's good to see all of these in some perspective. Right. And as you said, I think all of us are kind of figuring things out, right? Whether as investors or founders or operators. Another thing that happened in 2021 was this whole explosion of wealth tech as such, right? I mean, you saw a record number of investors come into the equity markets, for example. You had all kinds of fintech innovation, whether it is, BNPL or, people selling all kinds of assets. The lesser said about crypto, the better. But, we had all of this happen, right? Post 2021. And this is again in very stark contrast to the typical Indian mindset of buy gold or put money in FD or real estate and whatnot. How do you think the attitudes on that front has changed over the years?
Yeah, look, I think it's been in the works for a while. I would say what we saw in 2020, 2021 was COVID became a catalyst for some of these. But the changes in the consumer behavior and broader structural factors were at play for last 10 years. And I think you touched upon some of those things, right? So Indians have always saved very well. We've always been a savings economy, savings country. But people have saved predominantly in deposits, gold, and real estate. And I think each of these three have been taking a massive beating over the last 10 years, 12 years. Like, for example, if you remember, Roshan, 13 years ago, you could actually go to a bank and get a 10% fixed deposit rate, 12% fixed FD rate, right? Now,
Crazy.
it had gone down 1 to 4.5%. Now it's back up to 6.5%. So interest rates falling has had a huge impact, but it happened over 10 years. Right? It was not like 10 became 4 in one go. It kept happening, and suddenly people woke up and say, hey, look what's happening. The other was gold. From 1973, 74 to 2011, gold had a one-way street. Gold would defy gravity throughout. From 2011 to 2019, if you see, gold has been very volatile, like pretty much the same. Gold didn't make any money in that 7-8 period. And real estate ran into demonetization first and then into the RERA Act, right? Just the transaction cost, etc., became so hard. This was one part. On the other end, a bunch of other things started happening. the Indian market started doing really well. Sensex started delivering 10, 12%, sometimes 14% CAGR. And then Aadhaar happened, and then this whole eKYC, ease of access, everything happened, and suddenly you have a really great cocktail of incumbent assets not doing well, incumbent storages of wealth, and easier and the new alternative assets, let's call it alternatives in this one, the stock markets for this segment, that doing well, and the switch over from traditional to this new became easy because of whole Aadhaar based KYC and all, right? And this just resulted in an explosion over the last 3-4 years. So I would say, and by the way, one is we typically tend to say, hey, listen, this is all by millennials and stuff like that, right? I have seen risk appetite going in tier 2, tier 3 cut towns, people in their 30s and 40s and 50s, because they say, look, I am getting 5% pre-tax return on my bank deposit. I might as well put some of my assets from my bank deposit into, let's say, a mutual fund, or buy some stocks, or put in some nifty 50 stocks, etc. I think one change I would say is the risk appetite of average Indians has dramatically gone up, Roshan, in the last 6-7 years. I would say it was in the works for a long time. It's just that COVID exacerbated because people just had time. People just had more time. A lot of their social time, like movie time and all of that, got taken away. So even with like half an hour extra in a day, people just work from home, and so that's the way I see it. I think it was in the works for a long time.
No, absolutely. And if you compare the compliance aspect as well, right? I mean, I think 2009, 2010, I remember opening my DMAT account and filling out, I don't know, what was it, maybe 18 pages of forms, and signing each of those forms. It was such a crazy mess. And in that sense, how the KYC process has been simplified by Aadhaar is just mind blowing, right? Today, I mean, in hardly any time you can onboard yourself to a platform and start trading as well. All of this, with all of this, the responsibility to sort of sell in a more mature way, right, is incumbent on the startups and the folks who are selling these products, right? I mean, we still have a very sort of a buyer beware world, and here I mean I think there have been problems not just with fintechs. People don't understand, for example, like the conventional banks and whatnot, right? I mean, they'll happily sell you a ULIP even though they understand, they know that it's not the most optimum thing for you, or you just look at them talking to some of the older folks in the bank and what kind of investment advice they will be getting, right? And so I feel overall there needs to be a sort of responsible selling per se, right? So how do you balance both of your ambitions, right? I mean, how do you balance the fact that, hey, you have to grow, you have to be really ambitious as a founder, and also recognize the fact that you also have to be responsible to your users and customers?
Yeah, look, again, great points, Roshan. This can again be a full-fledged podcast episode. I'm glad you brought it up. So I think there are two fundamental problems in the way financial services are sold, products are sold in any product, right? One is that of product complexity, and the other one is the principal agency problem that you alluded to. And for a lot of customers, the first one is also a problem. In general, historically in India, any financial product has been sold by throwing a ton of jargon, confusing the hell out of the customer, as opposed to telling the customer what it is. So, which is why even if you see a few years ago, some of the product names that were there for mutual fund names and ULIP names were really, really complicated names. They would sound like movie names versus, what is thankfully the regulator has been very, very forward looking in India. I'll come to the regulatory aspects in a minute. So I think this one is the product complexity and just jargons being packaged to sell products. And the associated product is the whole principal agency problem. I think principal agency problem is for real, which is, look, am I acting in the best interests of the end customers? I think, which is where I would say credit to the regulators in India. They've done a phenomenal job of moving from a situation where there is a significant principal agency problem to a situation where, the regulator, particularly the capital markets regulator, SEBI, is clearly on its direction to eliminate any kind of such problems. That's been done by, for example, all commissions for any kind of intermediaries are now on trail. So if you invest ₹1,00,000, I can earn revenues only as long as you're invested with me. And if you don't make money and you leave in three months, I don't make any more money, right? So there is a kind of an alignment that has been brought in. Regulators also been pushing hard on making more and more advisory than distribution, although that has its own sets of challenges. whichever way you say distribution versus advisory, at least there is an alignment of interest, because if you don't make money as a customer, I don't make money as an intermediary. I think that's a great sort of a piece. This is the price of wealth. Whereas when it comes to the stock markets, I would say, the industry has done generally a pretty good job. I think the industry is saying, hey, listen, the wealth tech platforms, including ourselves, are saying, look, we'll give you toolkits to, invest, but at the end of the day, the actual investing, etc., has to be done by you. And a lot of companies have been taking responsible steps to make sure that people don't buy some stock. For example, it's bizarre that when Yes Bank stock goes below 5 rupees or 10 rupees, the volume just goes through the roof. People think, hey, listen, look, it can't go down any further, right?
Yeah.
Some of that, I would say, is also about education and awareness and maturity. And maturity will come only through going through some cycles. I would say some learnings can only be had by mistakes. Like I, as a founder, some of the, I can learn on a podcast, but some learnings I just have to make those mistakes. Similarly for many investors, a lot of learnings come through by doing and making those mistakes. But thankfully, the magnitude of those mistakes are not very high. So coming back to your question, I think there is a huge responsibility on all the wealth tech platforms to make sure that they tell the customer what the customers are doing. Many customers are just doing because they just don't know, like buying a stock, which is 3 rupees just because it was 10 rupees like a year before, right? And I think we have a responsibility to tell the customer. And the second one is we have a responsibility to tell the customer, look, what are we getting when the customer is doing a transaction? Like how much money are we earning, if at all we are earning, right? And I don't think all those transparency is absolutely necessary. I would say in a lot of situations, it comes down to the DNA of the founders and the DNA of the companies. And the companies just have to make it a matter of principle, saying that, look, serving the best interest of the customer and being regulatory wise compliant has to be of strategic importance, and not just look, I say it in the posters or my emailers or websites, etc. You have to really, really practice it. And I think having strong guardrails on each of both these parameters, one is making sure that customers first, and this one is essential. The way I would tell my colleagues is the following. If you are not going to buy this product yourself, and if you are not going to sell this product to your brother or sister, don't sell to any customer. Right? Eat your own dog food. If you think this is a great product, you would bet your money, then make it available to your customer. So I think that what makes it, then it makes us, hey, look, we are alive. I personally am a buyer of this product. Hence, I have a morally much more pride to be able to go and recommend these products. As you know, when companies just want scale, all kinds of wrong things can happen, as we've seen in multiple financial services businesses, whether it is credit businesses or investment businesses, insurance businesses. There's a lot of dirt that can come around. So I think founders have a huge responsibility to make sure that they themselves and their teams stay grounded to the core value of, hey, look, if I'm not going to buy this product for myself, I'm not going to sell this product to the customer.
This episode of the Startup Operator podcast is brought to you by Park Avenue. Now that we're all back at the office meeting colleagues and clients, it's time to ditch those PJs and look sharp with Park Avenue's range of 100% cotton, wrinkle-free shirts. They're super easy to maintain and keep you looking fresh through the day. So my fellow startup operators, visit the Park Avenue store or myraymond.com and check out the new wrinkle-free shirt collection. Yeah. No, I think imputing that kind of skin in the game is very, very important. Exchanges have been in the news for all the wrong reasons. I mean, with what happened to FTX and that entire fiasco with Sam Bankman-Fried and everything. Every week I learn some new detail on that front, and my mind is just completely blown, right? I was listening to this podcast with Michael Saylor, and he was talking about some of the stuff that these folks were doing, and it's just outrageous. And I kind of thank our Indian regulators that we have such a great system here, right? I mean, for sure. But also, what many people don't realize is that running an exchange is really tough, right? I mean, it's a tough business to run. It's tough technically. It's tough to make money. It's so complicated, right? So why do you get into it, and can you also educate us on some of the nuances of how the business itself works, and what are the challenges and so on?
Yeah, you're absolutely right. I think we have to be really thankful to our regulators. They've protected a lot of stuff that's going on in the rest of the world. I would say we have one of the better financial regulatory infrastructure as well as digital infrastructure in this country. So what we do at Fisdom, Roshan, is we help customers access savings, investments, and taxation solutions In terms of nuts and bolts on the Fisdom app, customers can buy mutual funds, stocks, pension funds, file their taxes. We cater to both retail and mass affluent segment of customers. Mass affluent segment is done under the branding of Fisdom Private Wealth, and retail is under Fisdom. So that's the core product. So consumer app, downloadable on Google Play and App Store, etc. But the way we reach end customers is not through direct to customer route. We don't do marketing and branding, but we reach end customers through partnerships. We have so far partnered with 15 banks, where these banks offer Fisdom to their end customers through technology integrations and business integrations. So Fisdom app is integrated into apps of about 15 banks, mobile apps. So we have the landing page presence where there's a tile called Wealth Management. Users click on it, Fisdom app comes up, then in there we do integrations and the customers can do on their own. So it's a consumer product, but the B2B2C distribution is what we do across all our product. And many of the reasons for pursuing some of these strategies is because of the learnings that I've had as an investor long ago. I think India is fundamentally a country where customer acquisition is very, very expensive. We are a business where trust is crucial, and trust takes either time or a lot of money. And we want to build generally an efficient business, not a company that raises hundreds and hundreds of $1 billion for generating $5 million of revenues, right? So we said, look, we have to be efficient, we have to be effective, we have to be efficient, and we have to be profitable. And trust takes time and money. So particularly, I keep joking, we're in the business of taking customers' money, right? Unlike, let's say, lending businesses, we're in the business of giving customers money, we're in the business of taking money from the customer. As a result, trust efficient has to be very, very high, right? So to that extent, we felt it was a great idea to partner with incumbent banks who already have trust of the customer, who already have distribution, and distribute our products through them rather than us trying to tell customers, hey, listen, come to us. So today, we work with about 15 banks, some large banks, some small banks. So we work with banks like Union Bank of India, Indian Bank, Karnataka Bank, City Union Bank, Tamil Nadu Mercantile Bank. Other than the top 5 banks who built a product of their own, there's a large number of banks in the country whom we work with and offer these solutions to their end customers. So as a result, a lot of our customers, about 60-70% of our customers are from tier 2, tier 3 towns. 2/3 of our customers are investing or accessing any kind of capital markets for the first time. That's the reason why we also started our mass affluent business, because if you think of a rich customer in a town like, let's say, Mysore or Bangalore or Salem, there is no effective products that are available there. But our bank partners have strong distribution there. So, it's a great way to offer some of our mass affluent or HNI products also in those, those specific geographies and segments. So that's sort of what we do at Fisdom, Roshan. Our pricing is generally very transparent to the end customer, and we make money only if the customer makes money. So, and the other realization is that any financial services company takes time. We have to be patient. It takes 15 years to build a business in this financial services world. And that's the realization both me and my co-founder Anand have had right from the beginning. We are like, hey, listen, this takes time. Let's be patient. There'll be cycles, there'll be ups and downs. This is a business of not selling. This is a business of retention. So wealth and investments is a business of not of selling. You don't make any money when you sell a product. You make money only when the customer stays with you for 5 years. So it's not necessary for me to have the largest number of customers. What is critical success factor is having a certain customer base and being deep with that customer base. And those are some of the insights we've had, right from the beginning, and we've tried to stay true to that, which is why, you wouldn't have been seeing us on IPL or Google or Facebook. So we don't do any of those crazy marketing or branding spends at Fisdom. So we are happy to play the long game, but the idea is to go really deep and, create value for the end customer. And as a derivative, we as shareholders, get some value out of it.
Right. When you offer portfolio services to your mass affluent customers, for example, right? I mean, then you become sort of more of a conventional financial entity than like a tech player per se, right? I wonder how that changes the DNA of the organization. Do you sort of think how that sort of changes the culture, and how do you build this organization? I mean, it feels like two different businesses in some sense, right? Where,
that's a great point, Roshan. I think I would say a company like ours has not just two, actually 3 types of different subcultures, if you will. One is the tech product orientation. The other one is sales orientation, and which is like typical sales orientation. The third one is ops, because as you alluded earlier, we're a regulated entity. There is a lot of operations involved, onboarding, transactions, customer support, so on and so forth, right? Which is a different type of people. So in a most companies like ours have three subcultures: tech, product, ops, and sales. And it's very, very important for founders to recognize this. Hey, listen, look, this is something that we need to make sure that the subcultures do not collide, and it is upon us to make sure that it becomes a melting pot where everybody learns from each other. For example, typically people in sales tend to be very aggressive and ambitious and driven, motivated to earn incentives and etc., whereas folks in tech and product tends to be more puritanical, right? In the sense, look, I need to get clarity. What is the customer impact? What is the life cycle behavior and all that? And people in ops tend to be methodical and structured, right? I think if all three, best of all three can be used and created a homogeneous culture, I think that's the best thing that the company can have. So the way I try to do is that, look, can tech product teams borrow some of the drive and hunger of sales teams? Similarly, can sales teams borrow some of the structured thinking of some of the other teams? So I think if we make a conscious effort after being aware of this, I think this is a problem that is fixable. Having said that, we have two segments. We have a retail segment and a mass affluent segment. Both of them have Fisdom app or a Fisdom product at the core. So the retail segment is just completely on its own. It's just an app that sits inside a bank app. Customers use on their own, DIY. There's even in our app there is an advice piece where customers can figure out what to buy based on some of the recommendations we make. So that's a purely product play. The mass affluent is a product play with a service layer on top of it, right? If we could avoid the service layer, we would love to do it. But the reality of India is we are not there yet where someone is going to invest 25 lakhs of rupees or 50 lakhs of rupees without having a recourse to be able to talk to somebody. And, maybe people like you and I would put in, that much amount of money, but that's a 0.1 percentile of the population of this country. Majority of the population, majority of the affluent people need recourse to somebody. It doesn't mean, they want to meet, every week, every month. I think the traditional whole big box wealth management, suited and booted wealth management, I think that's a declining business. Customers today are not interested in having conversations for no reason. I keep giving the examples of how how hiring a taxi has changed. If you remember 15 years ago, before the advent of Ola and Uber, you would book these city taxis and, you don't know where he is. You would call the guy before you have to go to the airport and you would ask, hey, where are you? What can you see? What time are you coming? Blah, blah, blah. So you would make a proactive attempt to call the customer. Now with Ola and Uber, if the guy calls you asking where is the address, you would say, hey, listen, why don't you see and just come? Similarly, 15 years ago, if you would go to a mall, you would want somebody to come and help you to buy some stuff. Today, if anybody in the shop comes to you and may I help you, say, look, I'll do it. So I think this traditional big box wealth management in terms of suited and booted where you engage with the customers, I think that is shrinking. So every wealth management firm, all the way from IFL Wealth, has to become technology oriented. There has to be a product at the core which reduces the human interactions, where the customer feels he or she is under control of what he or she is doing.
Yeah. No, I think it's also, there'll always be two different types of people, right? One will be the DIY people, do it yourself people who want to be left alone. And then you will have the do it for me people who will want that sort of a red glove, bespoke kind of a treatment for the kind of effort and investment that they're going to make. Since compliance and regulation has come up, right? I'd love to hear your thoughts on, how do you manage this whole aspect of your business? Because it's such a huge part, right? And if, founders are listening who are operating in fintech or considering an idea in fintech, which requires them to, similarly talk to regulators and so on, what are some principles they should keep in mind? What are some policies or hacks that you would have that could be easy for them to adopt?
So I think first thing, founders in fintech and financial services need to recognize that for a good reason, regulations in India are generally in a conservative frame of mind. What I mean by that conservative is that we as founders want to cater to 90% of the use cases. This is how you would, as a product manager, would think, right? If you were to build a product, you would say, hey, listen, let me solve this happy flow for 90% of the users, and remaining 10% of the users, I'll say, hey, listen, look, I don't cater to you. Regulators think exactly the opposite way. regulators stand for the last man standing, right? They're taking care of the last 10%. For companies are trying to cater to the 90%. There's an inherent, conflict is bigger word, but there's an inherent contradiction in the sheer approach of regulators and companies, right? And one has to recognize this. Second, as I said, we are in general in a conservative regulatory environment, not in an aggressive environment. We have to be thankful to that, because otherwise people would have lost a lot more money in cryptos and many of the scams that thankfully people haven't lost. I think third is we are going to be regulated even more. Like, if you think we are already regulated, no, that's not the case. We're going to be regulated even more. There are going to be more checks and balances that will come, because one, as a company, for example, we are doing business A. We're going to add more and more businesses, more and more product lines. Each of them individually are regulated again, either by the same regulator or other regulator. So the regulatory purview is only going to go higher and not lesser, right? So I think founders need to recognize this. We at Fisdom are very clear, and I would request all founders to keep it in mind that I think compliance has to be a strategic imperative, and not something that you would think, hey, listen, look, oh, this is a pain in the neck. No. The reason is, if you have license A and you think you're doing well and you want to go to license B, the regulator is going to look at your compliance track record, right? So it's not just a pain in the neck. For your own good, for your own company's sake, compliance has to be a strategic imperative, where you build a clean track record with the regulator of having complied and done well in everything that you are expected to do, so that the company can grow and you acquire more and more licenses and do more. So I think that awareness that this is likely to continue and for right reasons is absolutely essential. If founders think, look, this is a pain in the neck, that's just not a good starting point.
Yeah. From everything that you've learned running this business, right? I mean, if there was a founder contemplating building a similar business, right? Of course, you would want them to join you rather in an entrepreneurial role per se, right? But let's say, they want to venture out in this space and build something else in the wealth tech space, right? What are some nuances of running this business? What are those unintuitive things that are probably only known to, operators who have been there for 5-10 years executing in the space?
No, great. So I think the first one is, you don't have to worry, market is great. So one thing at this point of time, India is massively underpenetrated across all financial services. So good news to start point, as a starting point, is market is large, market is deep, so you don't have to worry about it. The things that are not obvious from outside, Roshan, are some like the following. One is financial services and fintech is an ecosystem play. What I mean by that is, every financial services company has significant dependency on lots of external parties and platforms that you don't exactly control. Unlike let's say if you're running a SaaS business, right? You're largely under control. You only have dependence on your customers. But here you have, let's say, dependence on exchanges and DPs and vendors and KRS and there's payment gateways and regulatory tech companies that you use. So there are so many external dependencies that you don't always control some of those external dependencies. I think it's important to recognize, because it can slow you down, and it does slow you down, and for right reason. Second, we spoke about regulations just a while earlier, and I think it is important to recognize that regulations are a work in progress. They keep changing every now and then. Like we keep joking, every day, there is some other new regulatory development from one of the regulators that we work under, right? So there are just a lot of regulatory work that gets done by your product team. So you need to budget 20 to 30% of your product and tech team's bandwidth just for regulatory work or compliance work. What that means is, this change will not deliver additional value to end customers, but it is important for you to sort of keep that in mind. For to have a regulatory track record, you need to have that, right? So those are two key learnings that I've had. And the third one is, I would say, take a long view of life. If you're in financial services, it takes time. Financial services are organic businesses. You could get lucky, or you could manufacture scale in a short term, but it takes time. It takes 10-15 years to build an institution, whether you're a payments company or a credit business or an insurance business or a wealth business. Within each of these, if you're taking any sliver, it does take time. Unlike, let's say, a food business or a transportation business or e-commerce, you can't manufacture scale by throwing money at the problem. there is a certain organic nature to this business. That's something that you have to sort of be patient. And the final point is, this is a business of trust. And, I think it's important to recognize that it's very not very obvious, from outside. You build a great product, customers lap it up. No, customers take time. Customers want to try it out and so on and so forth. So trust is a big deal. Unlike, let's say, again, some other product company, like a food business, where you could check whether the product works or not by just ordering and it'll get delivered in half an hour. In many situations, what fintech companies, particularly wealth tech companies, are selling is hope of a better future. There's no instant gratification. So it takes time, it takes patience to build that trust. So better to go deep in customer relationships rather than just go wide in terms of customer relationships.
Yeah. No, I think financial services is perhaps the hardest to sell, right? I mean, first of all, you're selling intangibles, right? It's not like you can sit in a car, take a spin, smell the leather or something of that sort and be influenced, right? And second is you're getting money upfront. You're taking people's hard-earned money upfront. And so, I mean, the trust aspect that you spoke about, I think is very, very key, right? What are some 2 or 3 ways that you have found to sort of induce more trust in the customers? I know, I mean, the B2B2C route solves a lot of things for you, right? When you can leverage another brand name as such, established brand name as such, but individually, when you do approach these customers, how do you improve trust?
Oh, yeah. So one is, as you said, the channel plays the role. The reason why we've taken a B2B2C partner and distribution is we want to leverage the trust that someone like a Karnataka bank or a City Union bank or an Indian bank have already built with the customer, so that our job becomes easy. But having said that, I think the product still plays a key role. For example, how transparent the information that is available. Like if we are recommending, fund ABC for an investment of a 5,000 rupee SIP, is there adequate information about why these three funds? What are the fees that I am charging? Is there enough transparency of communication in a jargon-free environment? And customers, as they keep using, they get comfortable with it. Similarly, from a transparency perspective, if the customer is looking to sell some of his stocks or mutual funds, are we transparently telling the customer on, hey, listen, look, if you do this, you're going to incur this much of taxes, you're going to incur this much of load, and this is the amount of money you get. And that customers feel, hey, listen, look, I think transparency is a very, very key part of building trust in this business. And customers keep using it over a period of time. They do pattern matching and say, yeah, look, I think I know what I'm getting, and it seems like it's congruent to what is being promised. As I said earlier, it takes a bit time for customers to build trust in this business. Which is why among all categories, Roshan, you would have seen the one category where people talk least is financial services and probably healthcare as well. No one goes and says, hey, listen, I had this great experience in this hospital, or I had this great experience with this bank, or, this insurance company. No one says, right? People say, I had this great experience in the restaurant and hotel and shop and this and that, right? So it's in people's own emotions, right? It's not something that excites them a lot. So
yeah. Yeah, I mean, you can only say mutual fund sahi hai, right? I mean, you can't even advertise some of the other values or benefits as such. Yeah. We're in the funding winter, as they say, and there's a lot of noise, a lot of doomsday predictions, and so on and so forth. For a founder who's listening to the podcast, how would you advise them to sort of tune out all of this noise and just focus on execution? What are some 2 or 3 things that they can do sort of to keep an even keel in these times?
Yeah, look, I think I would say we should all zone out of this external noise. As I said, life is never as bad as it looks like. As I see the markets, as I see the consumer behavior, actually there's a lot of tailwinds that many segments have from a consumer and market behavior perspective. The reason why there is a winter is because of external factors like companies getting valued ahead of their scale, companies not reaching their milestone that they had to get there. So as a result, what's happening is valuations are coming down, or companies have to let people go or cut pay packets to bring in some efficiencies, etc. So has there been a fundamental difference in the consumer behavior, product adoption, etc.? The answer is no. In India, actually, it's the opposite. We are bringing more and more people into this segment of depth rather than less. So point number one is, we should all zone this, keep this noise out, because nothing has changed. In fact, if at all it has changed, it has changed for the better. US might go through some slowdown, a recession, but look, frankly, we don't control that, right? So worrying about that doesn't really help any of us. So I would say things are not as bad as they look like from a market perspective. Funding perspective, absolutely, answer is yes. There, let's take a pragmatic view. Look, it's a cycle. We're in the down cycle. It will come up 6 months, 12 months down the line, which is why I would say we should all take a long view of life, not a 6 month, 12-month view, 36 months, 5 year, 7 year view. And these times, I think we should focus back on, hey, listen, let's enhance the consumer value, let's enhance the customer value. Are there adjacencies that we can capture? Can we go deep into any segment? In a very abstract way, let's say, let's strengthen our core at this point of time. And once we do that, maybe go after some adjacencies. So go more consumer focused as opposed to, funding and, VC and that world. No one knows when that world will come back, 6 months, 12 months, 18 months. Everyone has their own opinion. And sometimes it's also becomes a echo chamber where everyone starts saying the same thing. So ignore some of that. Like, for example, when COVID happened, I remember first 1 month, April, first 15 days, there was like complete negativity. People had shut shop, right? People thought world come to an end. Guess what? In 3 months, at least the capital markets and the funding market had recovered spectacularly. Who knows? It could be 3 months, it could be 18 months. So just ignore that noise and let's all focus on our core and strengthen that core.
Yeah. No, I think for a lot of folks listening, perhaps this is their first downturn in some sense, right? So they haven't really seen this. I mean, this is the first time that they're perceiving some of this stuff, and perhaps that is what is causing a little bit of the apprehension, right? But yeah, I mean, as you rightly mentioned, I think these are cycles. It goes up and down, and just focus on the consumer basically, right? Subu, before we let you go, I know it's a weekend. Thank you so much again for making the time. But before we let you go, what are some books or podcasts that you would recommend to our listeners?
Yeah, so Roshan, as I said, I am a very avid podcast listener. I spend a lot of time listening. When I commute or when I travel outside Bangalore, there's a lot of time that gets spent in friction loss. I use the time to listen to a lot of podcasts. Some of them I would recommend, again, would not be surprising for your listeners. Other than this podcast, I would say Deepak Jayaraman's Play to Potential is a very good podcast for senior executives and mid-career professionals. If you're interested in economics, politics, Amit Verma's The Seen and Unseen is a great one. Global Ones, Shane Parrish's Knowledge Podcast is a great one. Tim Ferriss Show is a great one. So these are some of the podcasts I would recommend your listeners to tune in. Books is harder because there's like just a infinite number of books that I can talk about. The most recent books that I've read are Marshall Goldsmith's books, The Earned Life. I think that's a brilliant book. Again, for founders who are trying to figure out, hey, listen, look, what next and how am I doing? How are we doing, etc. That's a great book. The Hard Thing About the Hard Things. I think that's a terrific book. Just a operational handbook, if you will, on a lot
That's the most recommended book on the podcast by far, actually.
Yeah. So that's what I said. So I books is the harder one to recommend because a lot of people recommend similar books, and there's just an infinite number of books that one can talk about. So yeah, those are some of the recommendations that I have for your listeners, Roshan.
Yeah. Thank you so much, Subu. This was a fun chat, and all the best for everything that you have coming up.
No, thanks, Roshan. Thanks for having me. This was a wonderful conversation. Thank you.
In the Park Avenue PowerPoint segment, we review some of the highlights of this conversation. Subu feels companies have a responsibility to inform customers about the risks their choices carry and how the companies gain when the customers use their services. Being transparent on this front builds a lot of trust. On what it takes to build a successful financial services company, Subu says it takes time to build one, and that it's a business of retention and not of selling. You make money when your customers stay with you and not just when you sell to them. And also, if you are building a financial services company, you can't manufacture scale by throwing money at the problem, like maybe in food tech or transport or e-commerce businesses. Subu says companies have to make it a matter of principle to serve the best interest of the consumer, and being compliant is of strategic importance and not just for the heck of it. And finally, on executing during a downturn, as we see now in late 2022, Subu says it's important to focus on your customers, double down on them and your core values and principles rather than the external noise. Well, folks, that's it on this episode. I hope you liked this one. If you did, then don't forget to rate and review us on your favorite platforms. It helps more people discover us. I'll see you again on another episode of the Startup Operator podcast with another amazing founder.